Hello, everyone. I am Michael Ruger. I am the managing partner of Greenbush Financial Group. A common question that we receive from individuals that are about to retire and they want to turn on their Social Security benefits as soon as they retire, but they're under the full retirement age for Social Security. They've done the research and they realize, hey, Mike, I've heard there's some earned income penalty associated with Social Security, which in 2025 is about $23,000. The problem is, if people have already worked for their company for 5 or 6 months, they have already maybe made more than the $23,000. So the question then becomes, am I forced to wait until the following year because I'm already over the income threshold, or does the income that I've earned prior to actually retiring and prior to actually turning on Social Security benefits not count? That is the exact topic that we're going to be covering today. And there's actually a flaw in the Social Security system where Social Security all too often tries to assess an earned income penalty that they shouldn't, that then requires the retiree to submit documentation to have that penalty removed. First, let's cover how the Social Security earned income penalty works. So in 2025, the threshold is $23,400 in earned income. So if somebody has turned on their Social Security benefit early and they have earned income above that $23,400 threshold, Social Security starts withholding $1 of the Social Security benefit for every $2 of earnings over that threshold. So essentially, it's a 50% penalty. So an example would be if someone earned, let's say, $33,400, which is exactly $10,000 over that earned income threshold, Social Security would assess a penalty of $5,000 against that individual's Social Security benefits. Now, the way Social Security assesses this earned income penalty is not a notice in the mail, then you got to write them a check, or it's something you do when you file your taxes. The way they actually assess the penalty is by withholding Social Security benefits in the next calendar year. So in that example, if there was a $5,000 penalty and the individual was receiving $2,000 a month in Social Security benefits, as soon as they realized they were over the income threshold, they will withhold essentially 3 months worth of payments. Now, if you do some quick math, they're getting $2,000 a month and 3 months, it's actually $6,000 to assess a $5,000 penalty. Wait a minute, they did a penalty too much. Well, the way Social Security works is they do not withhold partial months, only full months. So if you had an individual that, let's say, an extra $100 worth of the penalty, they will assess a full month of withholding of the Social Security benefit, and then Social Security benefits turn on the following month. Here is the major flaw in the Social Security system that gets exposed when someone retires and then turns on Social Security benefits in the same calendar year. So Social Security has no idea when you retire during the year. All they know is that you turn on Social Security benefits early, and when you file your tax return at the end of the year, you report what your earned income was. And if it's above that threshold, they try and assess the penalty. But what normally happens is if, let's say, a worker worked from January to June, and maybe they earn $40,000 in W-2 but during those 6 months, and then they want to turn on their Social Security benefits starting in July after all their paychecks are done, that's actually okay. And Social Security should not assess a penalty against that because technically the income stopped and then they've started receiving Social Security benefits after that. It's only an issue if you're receiving Social Security benefits while you're still working. In that scenario I just mentioned, knowing Social Security has no way to match up when the income stopped and when the Social Security benefits began, we coach clients to say in those scenarios, you should actually expect that Social Security is going to try to incorrectly assess an earned income penalty against your Social Security benefit the following year, which you will then have to appeal by saying, hey, here's my final paycheck for the company that showed I stopped working for them on June 15th. Here's my total earned income that I reported on my tax return, and the Social Security benefits did not start until July, so there's not an overlap, so do not assess the penalty. We will also have scenarios where clients will stop working for one employer, turn on their Social Security benefit, and then actually do something else in that same calendar year, whether it's part-time income or start a small company, which then starts generating income again, and the Social Security system has special rules for those individuals. So for an individual that works, let's say, January to May in their main career, stops working, turns on their Social Security benefit, and let's say they had already earned that $40,000, so Social Security is going to ignore that income that was earned up until May. They can successfully receive their Social Security benefits for June, July, August, but then let's say in September, they either start working part-time or they start some self-employment. Here comes this special assessment of how the earned income penalty is going to work for those final 4 months of the year. Social Security will allow these individuals to continue to collect their Social Security benefit without penalty as long as two items are fulfilled. The first one being is the monthly income received does not exceed $1,950, which is essentially the $23,400 annual limit divided by 12. And number two, the individual did not perform substantial services and self-employment. And the definition of substantial services meaning devoting more than 45 hours a month to the business or between 15 to 45 hours to a business in a highly skilled occupation. Exceeding either of those two thresholds will then trigger the earned income penalty. It's important to also note that once you reach full retirement age for Social Security, you are allowed to earn as much as you want, and this earned income penalty does not apply. The earned income penalty only applies to individuals that have turned on their Social Security prior to full retirement age and are still earning earned income. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thanks. Bye-bye.